So thanks again for your interest, and with that, I'll turn it over to Chris Crooks.
Okay, thank you, Nick. Welcome, everyone, and thank you for joining us today. We titled this presentation, This Time is Different. And we're usually skeptical when we hear that term, that this is a different environment, or PE ratios can't go any lower, or housing prices can't fall. So again, we're usually skeptical, but as investors, we look at company fundamentals, we look at earnings outlooks, and we look at valuations. But sometimes it's instructive to take a step back and look at the bigger picture, look at the economy, and maybe where it fits in terms of previous economic cycles. So what we'd like to do is look back at some analogs, some similar times in history that may be instructive. History obviously doesn't repeat, but sometimes you get some rhymes and some echoes. We'll look at what is different this time around, and then an economic and market outlook where we see things headed. So first of all, on this slide, we recognize that markets typically climb a wall of worry. On the left side, you can see some of the worries we've had over the years, and more recently, plenty of concerns that could derail this bull market. On the right side, you see a 15-year chart of the S&P 500 index. Now, the first gray bar over there is the recession, the great financial crisis of 2008, 2009. The market took quite a dip, but then rallied for a number of years until we hit the second bar, the gray bar there, which is the current pandemic, the COVID-19 virus, where the market, again, took a major tumble last year. In March, the economy shut down in the U.S. and around the world. But then the market, again, climbed that wall of worry. So we've had inflation kicking up recently, threats of tax law changes, higher interest rates, slower growth, extended valuations in the stock market, China with some property issues with a company called Evergrande, a possible slowdown there, possible supply chain disruptions. You can add your own worries to this list, but certainly a lot of things to worry about. The market on the right side starts to discount those initially, but then looks ahead to the future and what may be coming. So on the next slide here, what we'd like to do, since COVID-19 has been top of mind for all of us, it's impacted just about every area of life, the economy, it's restricted our travel, obviously, it's impacted corporate earnings, it's impacted Fed policy, it's impacted government spending, so basically influencing every area of life, and also the investments that we make here at Tower Bridge in terms of those companies that might benefit, unfortunately, from this epidemic, or trying to avoid those companies that might get hurt by the epidemic, such as some of the travel-related companies. So again, on the left side, we look back at one of the possible analogs, not that we're epidemiologists, not that we're trying to compare the Spanish flu back in 1918 to the current case. That was a flu virus. This is a different one. But in terms of the propagation and the reaction to a large shock to the economy, that's how we're looking at it. Now, back in the 1918 to 1920 period, we had a first wave of of influenza in the spring of that year. It was relatively mild. There was a second wave later that year that was much stronger, and then the third wave the following year. And after a couple of years, Spanish flu faded away. Now, flu is endemic to what we deal with every year now, but the severity and the number of deaths back then were really a major shock to the system. So that's how we're looking at that period of time. Travel was restricted. This picture on the left is a trolley car in Seattle. You could not enter that trolley car if you didn't have a mask, so masks were becoming prevalent. The federal response to the influenza back then was not really great. You won't find it in many speeches. There's a lot of good books, on the influenza back then that you can read, but again, the response was local. Masking was really the only response that you could take at that point, because we didn't have vaccinations, we didn't have testing, so it was it was avoidance and masking and social distancing. So that, at least we understood that back then. And on the right side is a subway car today. Work back then, again, masking might have been required, but you couldn't work remotely. Today, a large portion of the workforce was able to work remotely. We do have vaccines now, we have testing, we have treatments, so work is a little bit different today than it was back then. And also sports. Back then, some masking during the game. Recently, the masks have come off, and people in the stands, fans, are able to enjoy the game since a lot of us are vaccinated, and return to some semblance of normalcy, and it seems like we're getting there. So again, not trying to compare the stock market back then to what happens today, but if you look at what happened back in the 1900s, late 1900s, you did have a World War I going on from 1914 to 1918. But when the pandemic hit, the stock market, did take a bit of a tumble. But then as the influenza propagated through the world, as soldiers.
Apologies, we lost the audio. We have no idea. The line looks like it was still good, but we know we lost the audio for a couple of slides. So maybe we'll just backtrack real quickly a couple of slides and go from there. Thanks, everybody.
Okay. So how far back?
Yeah, that's good.
About 5 minutes?
Next one's good. Yeah.
Okay. So keeping up with that theme, in terms of recent recessions and the quick snapback that we had after reopening, previously it took about 10 years to get back to normal levels of capacity utilization in the economy. This last period, we snapped back very quickly. Same with unemployment. We shut down the economy, unemployment spiked to 15%, but we had a rapid return in employment. Sort of a strange anomaly is we have 10 or 11 million unfilled jobs and only about 8 million people unemployed. A number of people have left the workforce, but unemployment is ticking down to about 4.8% in the most recent month. And we really have a difficulty getting workers. And so we're all aware there are about 60,000 truck drivers in terms of shortage. Can't get people to work at restaurants and in other capacities. So there are a number of ways to solve that. One is to raise wages. And so in terms of inventories, inventories are short. The port, as I mentioned, is hopefully getting fixed. The Biden administration is jumping in, trying to work with UPS, Walmart, FedEx, Target, just about anybody who can get a truck out there to work 24/7. So we think that will take some time to improve, but it will happen. So it may bypass this current holiday season, but into next year, we should see some more normalization of traffic flow. The flip side of that coin in the interim, in the short run, is that inflation has run up quite a bit. So whether it's a coal shortage in China leading to shutdown of some factories, whether it's lack of drivers, lack of plastics, we really have now an inflationary problem, which has lasted more than 5 months, above 5%. So what you're seeing is the Federal Reserve talking about tapering their bond purchases, possibly raising interest rates. What you see here is a long-term chart back to 1960 of inflation in the blue line, and the Federal Reserve interest rate changes in the red line. So obviously the 1970s and into the early 80s was a period of high inflation. the Federal Reserve is able to tap the brakes, raise interest rates, and bring inflation down. Once you get through the period of 2008, you had a period where you had too little inflation for the Fed. You had negative real interest rates. Fed dropped interest rates basically to zero for 7 years, trying to get some improvement in inflation rates to try to maintain a non-deflationary period. So I think the opposite of what the Fed wants is not too much inflation, but certainly not a deflationary period, as you saw back in some of the other periods like the 1930s. So on the far right of that chart, that's a long-term chart, is a short-term chart. And the arrow points out this uptick in inflation that we've seen. The bond market is been reacting to that with sort of a benign reaction, believing that this inflation is transitory. Whether it is or not, as I said, we've had about 5 months of now 5% plus year-over-year growth in inflation. You're seeing the Fed reacting by signaling that they may possibly stop the $120 billion a year in purchases of bonds and mortgage-backed securities. And then into next year, we may see some increases in interest rates. So now for the current cycle. And I guess the good news is this is a chart on the left of U.S. cases of COVID. Again, we had a mild initial bump in cases, more severity as the virus is propagated through the population. What we thought was a tailing off of cases in the middle of 2000, vaccinations improving, and then a resurgence. So in the short run, we've had a little bit of a curtailment of growth, and the markets have reacted to that. But we do have vaccinations improving. 56% of the population is fully vaccinated. And in terms of people who are over 65, about 85% are fully vaccinated. So those are positive trends, and I think pointing us in the right direction. We certainly can't predict the path of COVID, but in terms of the trends in the near term, we do see some reopening taking place. So in terms of the left-hand chart here, you see diners getting back into restaurants. You may need a vaccination card to get in, but you're seeing a large reopening of people getting out into normal activity. Air traffic has not rebounded to prior levels, although bookings are increasing quite a bit. And I think Delta Airlines recently stated that they think business travel is going to come back. That's been a weak area for a while. Leisure travel has gone through fits and starts, but business travel may come back next year into the 80% range. Still not back to pre-pandemic levels. I think most companies are realizing that they can work with a hybrid model, that remote work is possible, and that productivity can continue to improve with the workers that we have, because hiring again is certainly a major issue right now. On the right side of the chart, commodities, you can name it: oil, copper, cotton, natural gas, all rising very rapidly. And as supply chain issues improve, that'll improve next year. In terms of the economic outlook, world growth for 2021, almost in the books, been pretty robust in terms of the rebound, a little bit of a slowdown short term. We're looking into next year. We do expect GDP growth for most economies to be relatively good. Volatility, I think you'll see around tapering. There's been a little bit of a slowdown in China, but once we work through those issues, we still expect reasonable growth throughout the world in the next year. Bringing that back to the U.S. economy, these are projections from the Federal Reserve for the next 5 years. Still reasonable single-digit real GDP growth. Inflation, we'll see what happens with that longer term. But, again, stable growth, we would expect getting back to a trend line growth rate over time. There are some risks. Obviously, the trajectory of interest rates are one risk. New tax law and spending changes are still in the works. We're running, higher and higher levels of debt. And as interest rates increase, the interest expense in that debt does increase as well. If you look at, projections from the Congressional Budget Office out to 2030, those numbers are for, significant increases in the debt level. We've got about $28 trillion in debt, going to possibly $40 trillion in debt. And with interest rates moving up into the 2 to 3%, it will certainly be a large amount of interest expense that we'll need to fund of the federal debt. But at this point, looking ahead to what the Fed thinks in terms of interest rates, this is the dot plot that you hear from the Federal Reserve and the individual members and projections of what might happen to interest rates. So getting back to a 1.5 to 2% level in terms of interest rates, the 10-year interest rate already, probably ahead of where the Fed is, in the 1 to 0.6% range. But most expectations are that we'll get back to sort of that 2 to 3% range in the longer run. In terms of interest rates, we've been there before. We think it's manageable for the, for the level of economic activity that we have. And without stunting growth too much, we think that's probably where we're headed at this point. And in terms of valuations, one of the risks when you do get valuations, and maybe that chart is cut off a little bit on the far right, but this is a 20-year chart of the PE multiples of the S&P 500. And what we've seen is a run-up in multiples and valuations to levels that we haven't seen for a long time. Now, the average in terms of the S&P 500 is in the teens, mid-teens. So having a 20-plus multiple in the S&P 500 with low interest rates is reasonable. But when you start to see interest rates creep up, you start to discount those earnings into the future, you can get some compression in terms of what multiple you put on those earnings for the S&P 500. So recently, you have seen some compression in the PE level, which I think is rational. If rates go up slowly and PEs come in a little bit as earnings grow, that's perfectly normal. But we do think, if you look back at prior cycles of history, when you start at a high PE level, future returns are usually not as good over the following 10-year period. So if you look at having had a great run last year, 18.4% rise in the S&P total return, up about 16-17% this year already. We don't expect those types of numbers to continue with earnings growth in the maybe 5 to 15% range going forward. So we think selectivity is going to be key in terms of which sectors you're in, which stocks you're in. And we think that we are in a bit of a transition period in terms of what's happening in terms of legislation and tax laws and interest rates. So real quick, just 2 more slides. Looking back, we've already had a very rapid recession and a very fast recovery. We've had significant stimulus for COVID, over $6 trillion at least approved, maybe not all spent. Inflation has been running higher than the Fed would like and higher than recent expectations. But what we don't have is a post-war economy. So you don't have all that slack in the economy. What you do have is a shock and basically a shutdown and a reopening from COVID. So demand is not our problem right now. It's supply. So we think as we work through those issues, we will have maybe a return to normalcy once we get into the next few years. So looking ahead, we'd expect a full economic reopening. Obviously, depending upon what happens to COVID and variants, we can't predict that. But assuming we work through this pandemic as we have in the past, we will get through this pandemic. Inflation, too much money chasing too few goods, that will clear. The ways to clear that in the market is to raise prices, which is happening, raise wages, which is taking place. You're seeing companies like Bank of America raising wages to $20 an hour to start. They're already talking about $25 in 2025. So that's one way to clear the market, is continue to raise wages. So that will pull workers back in, and to raise interest rates. So the Fed has signaled that they're going to begin tapering, whether it's November or December. It remains to be seen, but certainly by the end of next year, we'd expect that tapering process to be in full swing. Then what happens to yields in the 10-year? So if we stay in that 1.5 to 2.5 rate for interest rates, PE valuations can work down, but they can work through that as earnings continue to rise. So a more stable environment. We do expect EPS growth to continue. What we don't know is what will happen with tax law changes and in terms of corporate rates, doing away with the step up in basis for inheritance, and certainly what will happen with the infrastructure bill. We'll leave that to another presentation. That's yet to be seen, what will happen with legislation. But in the interim, a little bit of choppiness. Today, certainly a good reaction to what's taking place with the supply chain. But what we don't know is what happens with legislation. So short term, a little bit of risk out there. We think that the clouds will lift, and long term, we do see favorable conditions in terms of GDP growth and corporate earnings as we move ahead. So again, sorry about the audio issues. Hopefully you can all hear me, and we'll take some questions.
So at this point, if you have a question, please go down to the bottom of your screen of the chat panel, click on the chat icon, and a panel will come up where you can ask a question. We had a couple questions already, so let me just jump in. So the first one is, what industries do you think will benefit as rates increase in the coming years?
Yeah, that's a good question. So as rates increase, if they increase at a measured pace, financials will benefit. Banks and financial companies that depend on net interest margins, JP Morgan, some of the big money center banks, maybe some of the regional banks, but they've been struggling. Companies like Charles Schwab, which depend on the interest rate margins a little bit, so those will benefit. With rapid increases in interest rates and inflation, you can look at some of the materials companies. Energy certainly benefiting. Energy's up about 50% this year. Financials are up over 20% this year. So you can kind of get some indication of what might happen as interest rates start to rise. So we think that will, if it's a measured rise in rates, some of those companies we think will benefit.
Great. What about the outlook for gold and silver at this point? Any comments on those currencies?
Gold is an interesting asset. It's been a store of value, obviously, for many, many years and millennia, but it doesn't generate any earnings. It doesn't have any dividends. So unless you invest in some of the gold mining companies, gold as a store of value or as an inflation hedge has gone through some strange periods. Back in the 70s, you had some people flocking to gold as an investment. But through the 80s and a long period of time, gold really didn't do much. You could get it for about $400 an ounce. It's now about $1,800 an ounce. So it has run up, but it's off about 7% year to date. So what does that mean? If inflation is up and gold is down 7%, not a great inflation hedge. Some studies have suggested that maybe investors are looking at Bitcoin or some of the cryptocurrencies as more of an inflation hedge. The correlation there is to the stock market and to interest rates is not as clear. Some days crypto is up, some days it's down with the market, so not as clear. But Yeah, sure. Gold as a small part of a portfolio doesn't really hurt you, but again, it doesn't really pay anything in terms of dividends or have any earnings.
Great. You touched on another question that just came up on crypto. Do you see any impact in the current environment of crypto one way or the other?
Yeah, I think it's got a lot of interest, but crypto as a currency, it's a very volatile investment. Again, it doesn't generate any earnings. There's been some fraud in that space. So, certainly as a currency, it's gone between 25,000 to 50,000 and back within a 50 to 100% band in the past year. The dollar's gone in about a 2% band. So not a great currency if you want to use Bitcoin or Ethereum or Litecoin or some other digital currency to buy something or to hold as a store of value. So in terms of what happens to crypto, does it become a digital currency or is a new digital currency created by central banks? We're seeing a lot of talk about that around the world. That's more likely. But crypto as an investment, again, as maybe a non-correlated investment to the stock market, maybe having a little bit in the portfolio as a speculation is interesting. But as an investment, it's really hard to find anything to, put your finger on in terms of earnings or long-term value.
Great. You brought up the issue about the ports. With the new announcement about the Biden administration moving ports to 24/7, what impact do you think that will have on the supply chain and on the economy in the near term?
Anything can help at this point. So, moving more goods through through LA and through Long Branch and other ports certainly will help. It may not help this season. There are 60, 70 ships waiting. There are hundreds of thousands of large containers off port. And when you think you can't get something, what do? You go out and try to get it, whether that's, food or clothing or the latest toy. 85% of our toys are coming out of China. So if you're looking to buy that, you probably won't get it unless it's on the store shelves. So longer term, those things will clear. The market does clear, whether it's, paying drivers more money to work those areas, whether it's involving UPS and FedEx and Target, and Walmart, it'll clear. They may take a few quarters, but it's better to have a demand problem than a supply problem in this case. So it's not like we're seeing a big demand destruction at this point. Demand is there. You just can't get all the goods. So temporary inflation, I think, is the result in the near term. We'll have to live through that. On the flip side, cost of living adjustments for Social Security are going up for 22, about 5.9%. That's the highest in 40 years. So that should give you some indication of where we are in terms of inflation. So again, market will clear in terms of wages, in terms of the ports, in terms of prices, but we're all going to live with a little bit of inflation in the near term.
Great. Well, thanks, Chris, and thank you all for participating today. And again, our apologies for the audio problems. We hope it wasn't too much of an inconvenience. Thanks again for participating. Have a great evening.
Thank you.